So good afternoon, ladies and gentlemen. Welcome to the Cutting the Jargon pensions seminar, or webinar. This webinar was due to run a couple of weeks ago. We did delay it due to the period of national mourning for Her Majesty the Queen. So thanks for your patience. It was originally tied in with Pension Awareness Week, which is an ironic title because I think pensions generically are perhaps an asset that the majority of the people in the UK, the adult working population, have, but they're not something necessarily people readily engage with. And I think you could almost say they're almost a little bit boring, yet actually they have a profound effect on our lives in the future. So the aim of this, if you like, webinar is to help debunk some of the terminology that the industry insists on using, which are really rather they wouldn't. Pensions or retirement planning is very much about, as a personal thing to every individual. And it really is around understanding what your pension means for you and how you can make better decisions to improve your retirement outcomes. So the seminars we run through includes myself. My name's Roy Thompson. I head up Carpenter Box Financial Advisors, and I got with me my colleague Ross Baumann. Ross is an advisor within our team, and a lot of the work that we both do is around that retirement planning. So there's a small Q&A icon in the bottom of your screen. If you have any questions about anything we're talking about as we go through, please type your question in there. We seek to answer those at the end. The presentation itself may be 25, 30 minutes, something of that nature, and hopefully we can cover off some of the most salient points. If you don't quite have time to catch everything, there will be a recording of this, which we'll send out to those people who've registered post the event, and we'll also place it on our website. So without further ado, what are we actually looking to talk about today? Well, I think the first thing that we perhaps want to cover off is state pension. And if we're looking at state pension, I think it makes most sense to talk about how that interacts with your own private pensions. Pensions can include workplace arrangements or occupational schemes, but the webinar will focus on state pension and private pensions. The question about whether you're saving enough for retirement, I see a lot of financial press sort of state that you need to be saving 10% of your income or a specific number along those lines. Actually, it's very different for different individuals, because it really amounts to the amount that you save for retirement gives you a bigger quantum of asset when you get there to retirement, which means that you can derive a bigger income if you want. So the right question is to understand actually what do you want as an income base when you get to retirement, and that will inform how much you really should be saving to try and give yourself a good chance of getting a good retirement outcome. As well as what you save, one of the things that is often misunderstood or perhaps not considered is the risks that you take with your investments within your pension. And I think that's really important. You can drive very different outcomes if you look at where and how your pension is actually invested. So we look to go through that. And then just some terminology. So we'll cover off some of the terminology that we see on a day-to-day basis when you get your pension statement. So that's the purpose, that's the agenda. So without further ado, we'll look at the state pension side of things. So the state pension over the course of the last few years, certainly for ladies, the state pension age has increased. It was 60, it's now increased out to 66. For men, it increased from 65 to 66. There's a lot of outcry around that, but actually the British public in general is living longer. So to coincide with that, the cost for the government, as people are living longer, the cost for the state pension has gone up. That's coincided with the fact that we got more older people who are at retirement age and less people in work. In fact, the COVID pandemic has accelerated that, as a lot of people have left the workplace, meaning there is a smaller number of employees today paying national insurance, and they're funding people in retirement receiving a state pension who are all living that much longer. So very much a requirement for a retreating state role. And against that, people have been undersaving for retirement. Interest rates clearly in the press over the course of the last over the course of this year, really. But up until this year, interest rates have been very, very low, making it very difficult for people to generate a return on the money they save for retirement. So interest rates being a factor there as well. And certainly when we say about pensions, the notion of people undersaving for retirement, I think pensions can be deemed as quite complicated. As a reference right at the beginning there, you might actually say they're a little bit boring, which is a shame, because actually with some clear understanding and guidance about what they can provide for you, they do remain a really valuable tool for retirement. So if we start by looking at what we can actually get for the state pension, so the date you reach your state pension age, or your age that you start becoming entitled to state pension, will very much depend upon your date of birth. So we can see there, depending upon where you sit, will give an indication as to when you will receive your state pension. I have to say, I was born in 1976. And whilst you would look at that and say, okay, well, I could expect to get my state pension age at 67, I really think that in reality, by the time I get there, my state pension age might be somewhat later than that. And that's going back to the statements that have just made: older population, less people in work. It will simply become unaffordable for the government, and a very easy thing for them to do politically is just to continue to defer that state pension age. The misnomers that people have, quite often husband and wife, they feel that one person's going to get a state pension and the other opposing spouse might get a smaller sum. Actually, the modern flat rate state pension, which came in 5-6 years ago, stated that everyone would get the same. It's dependent upon the number of years national insurance credits that you've got. You now need 35 years national insurance credits. A lot of people say, well, I haven't worked for 35 years. I might have spent a bit of time out looking after the children or actually caring for a family member. There are benefits that you can claim, such as, for example, child benefit, that will give you a credit towards your state pension. So what we would recommend for everyone to do is to get a forecast. What state pension have you already built up? So what entitlement have you already built up? Is there any holes in it? And what can be done to try and help you maximise what you get from the state? At the moment, it's still an inflation-linked benefit that the government provide from your age. And of course, that's extremely valuable. We only need to look at the current position with inflation to state that it's extremely valuable. So state pension, very much a cornerstone of people's retirement. If we look now, you're looking at just over £9,500 on an annual basis. If husband and wife both claim that, we can see that's a really good foundation of secure income for people's retirements. So if we look on from the state pension, what we start to look at is, or what we have to start to ask is, whether we're going to run out of money. Is £20,000 enough? And with that in mind, what I'm going to do is hand over to my colleague Ross, who will be able to talk to you a little bit about our feelings and thoughts on that subject.
Thanks, Roy. So probably one of the biggest questions we get as financial advisors, either people saving for retirement or moving into retirement, is ultimately, will I run out of money, or have I got enough to achieve the lifestyle that I want? So obviously income and benefits in retirement can come from many sources. Some people might own property portfolios as an example, but really what we're going to focus on today is more the pensions. So what sort of pensions can fund an income or access to capital in retirement. So if we look at sort of guaranteed income sources, Roy's touched on the state pension as a really reliable, secure income with some inflation protection that can really be the backbone to most people's retirement incomes. If you're fortunate enough to have a defined benefit pension, that can be another form of guaranteed income in retirement. So again, it can include inflation protection, and that can pay a fixed benefit for the duration of your retirement. Outside of those two income sources, there's the option to purchase an annuity. So what an annuity is effectively, if you build up some capital within your pension, you can approach an annuity provider or an insurance provider and exchange that capital for a secure income in retirement. Now, those that are seeking security and some certainty in retirement, that can be quite advantageous for them. But what you do give up, certainly with the annuity, is an element of flexibility. And if we look at the second option, here. So lump sums and Lamborghinis, slightly tongue-in-cheek poke at George Osborne. Some of you may remember in 2015, the introduction of pension freedoms, where the requirement to purchase annuity was removed, and actually they introduced Flexi access drawdown for all retirees. So it gave you access to all of your pension funds effectively. And he made the joke that retirees should be able to go out and buy Lamborghinis with their money. Slightly irresponsible, but actually, if we think about the legislation, a positive move for the market, whereby you've got complete flexibility to tailor your retirement around your specific objectives, if that is access to larger capital sums in early retirement, or a combination of flexible income alongside an annuity perhaps. It also opened up the retirement picture towards more flexible death benefits. So if you were looking to pass on money to either a spouse and or children, looking at legacy planning, it certainly opened up a lot more flexibility in that regard. So a positive step all round. As Roy touched on, look, people are living longer. It's one of the key factors that we need to look at when we're structuring a sustainable retirement income. Really, the three factors that we look at is, okay, when are you going to retire? How much do you want or need in retirement? And ultimately, how long do we think you're going to live for? So we've got some statistics up on the screen here. What this looks at is the Office of National Statistics report. And what it shows is the projected life expectancy for people at age 65 here in the UK. If you look at the 2018 numbers as the figures that are probably closest to today's date, what you can see is from the age of 65, men in 2018 were expected to live to, let's call it 88, and women 90. But really what we want to highlight is actually a pattern here. And the pattern is one that is increasing. So people are living longer as we get medical advancements. People generally living healthier lifestyles. It's a reasonable expectation to think that average life expectancy is going to continue to increase. And what does that mean for retirees? Well, what it means is your money will need to last longer. So those certainly going into drawdown as an example, where it's a pot of money that we need to sustain for a period of time, there's every chance it's got to do a bit more. It's got to work a little bit harder than certainly the generation before you. That obviously will still depend on how much you're looking to draw and the age at which you choose to retire. So what does that mean? The next couple of slides just try to get a little bit of an example of, okay, well, how much would I need in retirement? It's often a very hard question to answer. Certainly when we talk to people about, okay, when do you want to retire? How much are you going to need? It's quite difficult to sort of ascertain a target, certainly when you're a younger accumulator. So really what I'm trying to evidence here is a little bit of a flavour on, okay, what would you need to save to give yourself what we call a reasonable lifestyle in retirement. And the first one we'll look at really Flexi access drawdown. We'll come on to what an annuity might look like, but for Flexi access drawdown, okay, I need to accumulate a pot of money within my pension to sustain an income. This example looks at an investor who's currently 40. They're targeting a retirement income of £30,000 per annum in today's money, so the equivalent of £30,000 today. And they want that from age 65. Perfectly reasonable target. We've assumed here is that they're in employment, that they're going to acquire enough contributions towards the state pension to get a full state pension. And the other assumption here is that they've built up a pot of £100,000 so far, and they're making total pension contributions of £400 a month. Now, the illustration will also factor in inflation at 2.5%, accepting that right now, as current climate is considerably higher, but as a long-term average, we've assumed inflation at 2.5%, and then growth rates on those investments of 5.5% net of all charges. So what you can see here is actually between 40 and 65, it's an accumulating position. He's putting money in we're getting some investment growth. And by the time they reach age 65, what they've managed to do is accumulate a pension pot of 380,000 in today's money. In the background, they'll be getting their state pension at a certain age. So that's gonna help support some of the income. But actually what we can see is where they need to draw on an income of 30,000 a year, that position, even when we're achieving 5.5% investment growth, is one that is accumulating. So in this example, you can see actually if they did build up a pot of 380,000 in today's money and they were spending 30,000 a year, actually that money runs out roughly around sort of 84, 85. So what are we trying to show here? What we're trying to show is actually to build up a pot of money and sustain a healthy lifestyle. You do need to put away reasonable amounts of money. But yeah, it gives just a little illustration on the quantum of money that needs to be built up to support what is a pretty decent retirement, £30,000 per annum. But yeah, just to give you a flavour of what should you be targeting if you've got aspirations of similar sort of income targets. The next screen looks a little bit at I suppose annuity rates here. So annuity rates became less popular certainly since 2008, following the financial crash in 2008, the introduction of quantitative easing, and an even sharper dip in 2015 following George Osborne's announcements on pension freedom. So they've been less popular over the years, but still a very viable option for the right type of person in retirement. So as I touched on earlier, an annuity provides a secure income in retirement, but you give up your capital in order to secure that income. And really what this illustrates on the graph here is the impact on annuity rates over the years. So you can see back in 2008, that actually annuity rates about £7,908 for every £100,000 that you gave up of capital. So an annuity rate of about 7.9%. Now, what's happened over a period of time is that interest rates have fallen effectively. So they've been reduced over a period of time, and the annuity rates are directly linked to gilts, so government fixed interest. So direct link to interest rates, and when those interest rates reduce, so will annuity rates. Important to point out here that these rates do look at a level annuity, so this doesn't include any inflation protection, and it's on a single life basis. And what that means is it wouldn't provide any death benefits to a spouse or partner. So this really represents the maximum annuity rate without factoring in any medical enhancements. What you will note is that in recent times, actually, annuity rates are started to rise again. The impact of high rates of inflation that were experienced domestically and the reaction by the central bank to increase interest rates to tackle inflation has resulted in a rise in annuity rates, which could lead to potentially an increase in demand in that area.
Ross, that's really helpful. I guess what you're saying there is with the annuity rate might on the surface look even more the most attractive route. But what we have to remember is the chart that looked at the drawdown arrangement, where over a period of time the fund was eroded away, that factors in inflation, and the annuity chart that you've got here doesn't factor in inflation. So as you go through retirement, the spending power of that money, if you choose the annuity option and you choose a level option, would reduce over time.
Exactly that. Now, the annuity does have the flexibility to add in inflation protected benefits. You can add in death benefits, a spouse's pension, which will allocate a share of the pension after the first life has passed. All of these factors that you add in, however, will reduce that rate. So that rate of 6.1% in 2022, we'd expect that to come down if you're adding on inflation protection, if you're adding on death benefits. So really, this highlights probably the maximum rate that you could get without any medical enhancement. So we should also highlight that if you do have any ailments or heavy drinkers, heavy smokers, actually, when you come to retirement, going through a medical underwriting process with an annuity provider could give you an enhanced income from some of these rates as well. So it's always worth considering, but really they're two very different outcomes. The Flexi Access Drawdown and the annuity. It's really our job to sit down with clients and help them understand the pros and cons and really structure an effective income that meets their personal objectives.
And I think we arrive at perhaps a common myth, certainly when clients come to see me, their assumption is if let's say they're 40 years old and they're paying into a pension, that they've got a predetermined outcome, that they've almost got to buy an annuity when they get to retirement, or another arrangement. That the reality is they're separate things. As you save for retirement, you're building your wealth over a period of time. And then when you come to use your money in retirement, you do have this free choice about whether you use the money you've saved to buy an annuity, or whether you simply live off the interest, a drawdown arrangement, and draw money from your investment as and when you need it. And yes, what you're saying is, what's right for one might be wrong for someone else. So it's a very personal matter at that point.
Absolutely.
Yeah. So we're looking there, I guess, a little bit about how you use your money in retirement. I guess the other thing to think about is how you save money for retirement. And we know that we're going to get the state pension, which is what we would call a secure income stream. So we've got the set age that we're going to get those from. But what we want to look at is how you might save using a kind of a modern pension arrangement. You might think of it as a private pension. A lot of employers will operate what they call a workplace pension. Ross will talk a little bit more about that in a minute. But principally, they work under the same rules. And a lot of people, again, get the kind of misconceptions around private pensions. They think of Equitable Life historically, which perhaps led to a bad outcome for a number of clients. They think of the Robert Maxwell scenario where pension funds were, if you like, stolen or taken. The reality is a modern private pension is just a form of savings account. It's got some valuable tax incentives to help you save. So, for when you make contributions, the government will give you tax relief on your money. The money, once it's invested, will grow tax-free, and you can actually access some of that money tax-free when you get to retirement. And if you die, that money is not part of your estate. So all of those tax benefits come together to try and incentivize you to make investments into pensions. And that suite of tax benefits is really quite compelling. A lot of people will say to me, well, pensions are no good. Well, actually, if you look at all those tax benefits, mathematically, they will always work out as a really valuable form of savings and a strong lever you can pull to improve your retirement outcomes. What people often mean is that the investment that they've got within their pension is not very good. And actually, pensions can invest in a wide range of different assets to try and generate a return. And you can see here, we've got a little, if you like, a little bag. That's your pension pot. And within it, we've got a kind of a pictorial explanation of the sorts of things that can be held in there. So we can have kind of a savings account, just a normal savings account that can be owned by your pension. If we've got a savings account in our pension, it's like having a personal savings account. We get a little bit of interest. The money is held by the bank, and we feel nice and secure about that. But we're never going to generate a decent long-term return, especially against inflation, because interest rates are typically lower than inflation. We can invest our money in stocks and shares, and that's what people will think about quite a bit when they think about their pension arrangements. It's very typical for people to use stocks and shares, and they become very concerned around market blips such as we've had this year. Investment returns generically this year have been very, very poor, so returns in pensions have been very, very poor. However, over the longer run, history would suggest that those investments will generate a good return, a better than inflationary return. What we need to understand is how our money is invested along our journey. So if you're 40 years old and retirement is 20 years away, well, actually, it's reasonable to think that you should take an element of investment risk, and the quantum of investment risk will be different for each individual. But those investment risks we would think get rewarded by better returns over the long run. As you get nearer the point you want to use your money for retirement, a generic piece of advice is that you might want to reduce some of those risks that your money is set at. And that's because you don't want to save all your working career and find that you're about to use the money to buy an annuity, only to find that the stock market has gone down 20% and you've had that quantum of money wiped off the value of your pension pot. So pensions are not a bad thing. Where and how your money is invested in that is really important. Some other things there, people often don't consider, but it is perfectly possible in the right set of circumstances for your pension to be used to buy commercial property. Can't be used to buy residential property or buy-to-lets, but it can be used to buy commercial units. And we've got a lot of clients that we deal with who run their own business, and they've got their pension fund who buys the commercial unit from where they trade. Yeah, pensions, a wide range of different assets that can be invested in there. I mentioned in there about the tax incentives that are provided, and a lot of people will ask how those tax incentives compare to other options that are available. So we might have ISAs. They're a perfectly reasonable way to save for retirement. We might have some more esoteric investments, such as venture capital trusts or enterprise investment schemes. These are products and services that are available in the financial marketplace, which offer a tax incentive to help investors generate a return. And we don't have to rely simply on a pension for retirement. A lot of clients will look at a suite of different products to try and generate returns in a different fashion, and all of them will help towards that retirement goal. So for good retirement planning, we would say consider using all of your tax wrappers, not just your pension arrangements. It's looking at the most efficient way of doing that on an individual basis. Within those tax wrappers, I've mentioned about investment risk. So this chart just looks at what we mean by risk. So in a very simplistic manner, we can invest on a scale of between 1 and 10. So if we invest at 1, we're taking a very low risk with our money, and we would think that over a longer period of time, we would commonly get a lower return. However, if you invest right at that bottom scale, your chances of losing money are very much diminished. At the other end of the scale, 10 out of 10, we might find that we could generate wonderful returns, double-digit returns, way into double-digit returns, but we increase our risk of losing money. And it's really important to understand that those different levels of risk, there is a scale between 1 and 10 of where you can invest your money, and they will deliver a different outcome. It is not possible to invest in a very, very low risk plan and get really, really good returns, not over the longer run. It very much correlates to the risks that we take. So this just looks at, perhaps where we might sit at somewhere in the middle. So this might be on my scale of 1 to 10. This might look at investments that sit between kind of 3 and 7, something of that nature. So we might call them conservative, balanced, and growth. So conservative being at the lower end, balanced in the middle, and growth at the top end. And we can see in the line chart here, over a period of time, the pink line, which is the growth orientated line, has generated ultimately the best returns. This just looks over the last 5 years. However, those returns have come at the behest of a more volatile or a more wiggly line, in simple terms. So when markets fall, that pink line would typically fall further than the lower risk lines. So the risk that we're taking manifests itself in a bigger drop when markets fall, and over the longer run has historically been rewarded with better returns. Now, what we don't know is we don't know if there is a drop in the market. We don't know how long that will last for. And we can't guarantee that in the long run there would be ultimately a recovery. It's just that historically that's what we've seen. So this comes back to my point. If you're 20 years old and investing in your pension, you might typically see, although it is a personal position, that people might look more towards things that sit perhaps more towards the top end of the line. And that's because they can wait a long period of time before they're going to reach retirement, and they can afford to take those risks. If you were someone who is coming right up to retirement, the last few years of retirement, it's more likely that you would want something more at the lower end, more conservative. And the reason for that is you still want to generate some returns. However, you want those returns to be, not so volatile. We don't want to get right on top of retirement and find that we've lost 15 or 20% of the value of our pension asset just prior to retirement. It will have a profound effect on your outcome. So for most clients coming to me, what they don't really engage with is where their money is invested within their pension. There are lots of options. They take a different level of risk, and understanding how those risks fit into your goal is really, really important.
And Roy, obviously it's well publicised in the news that markets have been choppy, certainly year to date. Most recently, in light of the mini budget, the pound dropped significantly against dollar and other currencies. Generally, as a feel that markets have been pretty volatile. Should people be worried in the current market?
Well, I think we understand that they would absolutely be worried about what's happening. It's not very reassuring to read the news just at the moment and look at what's happening in the financial markets. Again, ultimately, we can't guarantee what's going to happen. If we knew that, we wouldn't be here delivering this presentation. But in historic terms, what has happened, if you think about the 2008 financial crash, if you think about the dot-com bubble at the end of the 90s and just into the 2000s, and if you think further back to the 70s, we had very similar, high inflation, increasing interest rates. We had those issues in the 70s. And what we find is that over time, markets recover from those lows. So again, if you are just coming up for retirement and you need to use your money, you might want to, you would be extra concerned about what's happening at this point in time. And you should definitely be speaking with someone and trying to understand the risks that you're taking. If you're that much younger and still saving for retirement, well, being an investor means that sometimes things go well and sometimes things go less well. But over the longer run, you should get rewarded for the risks that you take. So that those risks often manifest themselves in the assets that we buy, as we've said, and this simply looks at typically how an investment manager might make up the investments. These pie charts are very popular with pension companies, but the highest risk asset that you can look at is what we call equities, stocks and shares, and all the way through to money invested on the money market. That's not far away from kind of bank deposit accounts, really. So those different asset makeups will derive the risk that we take in our portfolio. So the bigger the equity share in your portfolio, the more risk invariably that you'll be taking with your pension arrangement. So here we've just got an example of something that might be invested in a fairly cautious way. It's got about 35% of the money invested in equities, and then a range of other assets to try and make up that portfolio. The biggest part of that being the fixed interest. These are government loans to corporates. And at the other end of the scale, you can see that pie chart changes. So we end up with a bigger chunk of money in equities. And therefore, that last one where we've got perhaps 70% or just over 70% of the money in equities, that's an example of a portfolio that would be taking a higher risk. And that's how the industry will seek to manage its risk arrangements. They will place more money in the higher risk assets. What's important to note is that all of those portfolios will have some money in those higher risk assets. It just depends upon the weighting that you get in the more cautious arrangements, which helps temper the returns that you get in those relevant portfolios.
So the next slide that I'm just going to take you through here is a little look at automatic enrolment pensions. So probably more relevant to people that perhaps are still working or have been part of an automatic enrolment pension during their working career. So automatic enrolment, what is it? So automatic enrolment was a piece of legislation that was brought into force in 2012. And really, it's on the back of some of the information we've shared today. So perhaps a slightly retreating state role, people living longer. So really, it was a move by the government to put the burden back on really personal employees and their employers to ensure that actually everyone's got enough for retirement. I think it's perfectly reasonable to expect that actually the state pension by itself is not enough to give you a good standard of living in retirement. So really the burden is on each individual and their employer to support that position and build up some private wealth in the form of a pension. So legislation was introduced that employees of a certain age earning certain salaries will be automatically enrolled into pension schemes. And basically, as you can see from the level of contributions here, the employee would have to put in a contribution and the employers would have to put in a contribution. Now, the level of contributions can vary from employer. There are set minimums. This aims just to give you a little illustration of what maybe a typical automatic enrolment scheme may look like. As you can see, the level of contributions from the employer around about 3%, and then an employee contribution of 4% net, and then that's topped up to 5% gross via tax relief. So regular contributions going into pension, building up your private pension wealth. So what are the benefits? Well, the benefits are that you're going to accumulate more money to enjoy in retirement. So that there's an obvious benefit there. Now, there is obviously a commitment from the employees to contribute to the pension as well. So if you weren't in automatic enrolment pension, as an example, you would have more in your pay packet. However, you would be giving up that employer contribution. So your employer is not necessarily going to pay you that 3% if you opt out of the pension scheme. So really the benefits of staying in the scheme it's effectively free money from employers. So it ticks a lot of boxes in terms of saving for retirement. And really the conversations we have with clients often is a case of that for 99.9% of people, it's in their best interest to be in the automatic enrolment scheme. And really the conversations are around putting more in. There's been a few studies recently around automatic enrolment. Are the contributions enough? And I think the general consensus is that for most people, they probably need to be putting in more to their pension. So automatic enrolment provides a good start, but certainly if you can get more into your pensions, then we would absolutely encourage that, especially when you can benefit from such things as tax relief and tax-free growth. The third point on there, so should I enroll or opt out? As I said, for the vast majority, it's in your best interest to stay in the automatic enrolment schemes. For the very rare few who may opt out, I think really the only examples where you might look to opt out if you've got some particularly expensive borrowing that you need to service, some expensive debt, or some real short-term objectives, like getting onto housing market as an example. They may be some examples where you might need the money in your pocket, but yeah, it's quite rare. It's a positive move by the government, and really it's a job of maximising the amount you can get into your pensions as soon as possible, because as we'll touch on a little bit later, the earlier you can get money into your pension, that compound growth over a period of time, it makes a real difference to the end position. The next slide is really just looking at a little bit of pension jargon, and we've sort of picked a few areas where we tend to get quite a few questions from clients. Arguably, the biggest one is charges. They're a reality of pensions. They're a reality of investing. If you invest money, then there's always going to be an element of charges. what we've seen in terms of pension charges over a number of years is actually the rate of charges applied has generally come down. Most modern day pensions are more cost effective than pension schemes set up a number of years ago. There's been legislation coming in about transparency, so people got to be more transparent around charges. And generally, as technology is advanced, actually, some of these pension providers can provide an improved service at reduced cost. So there can be a vast difference in the charges that you incur. So really, when we provide advice to our clients and we're looking at years, maybe we're looking at pensions they've acquired a number of years ago, it is quite a common feature to find actually they're paying a lot more than they probably should for these subpar pensions than what could be achieved in a modern day pension. Just looking at some of the bullet points here, so debunking terminology. So I've listed a few different charges examples. So there's AMC, OCF and TER. They probably won't mean a great deal to anyone outside of the financial sector, but really what it highlights is actually the vast different names for different charges that can be applied to pensions or investments. AMC stands for annual management charge. Now this would typically apply to active fund managers or active funds where you are paying a manager to make investment decisions. So they will take a charge, and quite often that can be known as the annual management charge. It can sometimes apply just to the underlying fund costs. So it's difficult when deciphering through different pension providers will still label some of their charges in a different way. The OCF, so it's the ongoing charge figure. So quite often this can include the total fund charge. Sometimes it will include the annual management charge as part of that. So OCF was brought in to sort of simplify charges statements. So if you see an OCF in your statements, typically it means the total charge for the underlying investment. And the TER was the total expense ratio. This was sort of the charge that similar to the OCF, but was probably just introduced before the OCF effectively simplified matters a bit. So again, it references the cost of the underlying investment. So just between those three charges alone, you can sort of see actually there's different terminology for very similar charges. So it's really our job as advisors to help clients understand the different types of charges and really hopefully get them to a position where we can improve that position, simplify the charges and provide cost-effective solutions moving forward. Any of those people that are in automatic enrolment schemes, so another positive step via the legislation was that there was a charging cap. So that's good news. You're not going to pay over the odds for your pension investment. So that's a really positive step. And then the last point being the impact of charges. Well, what is the impact of charges? Well, put it this way, if you have high level of charges, your investments are going to have to work harder to achieve net returns. So the charges are often something that we have a bit more control over when we compare that to market performance, which is more unpredictable. So actually making sure that the charges that we incur offer good value is a really, really important factor. And obviously we'd like to keep those charges as low as possible to give the investments the best chance of achieving the gains that we need to support an effective retirement strategy. The second point on here is the normal retirement date / age. So if we look at firstly the defined benefit world, so defined benefit pensions will have a set age or date at which you retire, and that's really the date where they're going to start paying you that secure income. Now, if you wanted to take that earlier than that date, there's a good chance that your pension may be reduced. And similarly, if you retire after that age, there's a good chance that they may increase that starting income. So it can be quite important on the defined benefit pension. And on the defined contribution pension, its importance can vary, to be honest. And it really comes down to the investment strategy that you're in. If you have just selected a fund and it has no lifestyling, and we'll come on to that in a moment. So you will stay in that fund unless you choose to change it, then actually that normal retirement age doesn't have as much of an impact. You can change that to align with your chosen retirement date, but actually your investments aren't necessarily going to change based on that date. Where it can have quite a large impact is if you are in a lifestyling fund. So a lifestyling fund or a lifestyle strategy is effectively a strategy whereby when you invest into the strategy and you're still accumulating, let's say you're in your 30s, it will automatically take a higher degree of risk. So Roy touched on this earlier, where you're a younger accumulator, you can afford to ride the waves of volatility in the markets. So this fund will automatically put you in a higher risk strategy, and then it will automatically reduce risk as you get closer to your normal retirement date or age. So the importance of that date is that you want that date to be correct or that age to be correct, because if you start reducing the risk of your investment too early or too late, that could impact your retirement. So actually, if you are in a lifestyling strategy, you want to make sure that that does align with your wishes, to make sure that the risk is coming off the table in line with that retirement age. You don't want to get to retirement and have too high a degree of risk, because volatile markets could result in sharp losses. Similarly, you don't want to de-risk too early and miss out on potentially a higher level of gains. Sorry, Roy, you're still on mute, sorry.
Forgive me, my fault. So what we're saying, Ross, is that if we go right the way back, there's some key things that people need to consider around their retirement planning. The first of all is trying to have some understanding of what we might be trying to achieve. So what sort of income might we want when we're retiring? And a very broad goal when you're younger is perfectly acceptable, and that comes more into focus as you get nearer and nearer retirement. It's really sensible to understand what state pension you'd be entitled to. So therefore, if we know what we're going to get with state pension and we know what our retirement income goal is, we can understand the quantum of gap there is between that state pension and our goal. And that gives an indication as to what level of assets that we need to retire on. If we're looking at our assets that we're retiring on, what we know is that pensions are a very tax efficient way of saving for that retirement plan. So looking at funding and making best use of your tax wrappers is really important. We also know that thinking about the level of risk that you take with your investments can have a profound outcome, a profoundly different outcome. So having a look and engaging with that is a really important part of the process. Setting those up so they're structured to tie in with a set retirement date is really useful. And looking at the charges that are being applied to your current pension arrangements is a valuable exercise. If you can extract some savings, compound it over a period of time, that can provide a real benefit. I guess the last point then is, when should I do this? Well, there's an old adage that, financial planning should have started kind of yesterday. And if you didn't do that, you should start today. And that's really because of the power of compound returns. And this chart simply looks at that. So the green line looks at a saver who saves £5,000 a year between the age of 25 and 65. I'm not sure I know too many people at the age of 25 who can afford to save £5,000 a year, but the theory is nonetheless correct. And assuming some reasonable returns, what we can see is that over that 40-year time span, they would have saved £200,000 and their plan would be worth over £1 million. Significant benefit of compound returns. What we then have is a blue saver and a red saver. So if we look at the red line, that's someone who starts early. So they start at age 25, but they only save for 10 years. So they would have saved £50,000. Whereas the blue line looks at someone who delays or defers the notion of saving. And actually, they only start at age 35. So starting just that 10 years later, but then continuing to save for 30 years until they're 65, they would have saved £150,000. It's clear that the green line produces the best outcome. That's the most saved for the longest period of time. But what's really startling is that the red saver still beats at age 65 the blue saver. So whilst they've only saved a third of the amount, they've actually generated a fund that's slightly higher in value than the blue saver. So starting early is profoundly important. So if you're thinking about your own retirement plans, there's plenty to think about. Carpenter Box would be more than happy to help. There are some clear directives, the points that I've raised, looking at the risk, looking at what you want, thinking about how long you're going to invest for, looking at the charges. They're all things you can do yourself, but we have the likes of Ross and other advisors in my team who would be more than happy to help and are professionally qualified to do so. If you have any questions, please do send them through. I can see there's none there in the chat today. But if you've got any questions following this, please do send them through. Or if you want to contact us at carpenterboxfa.com, we'd be happy to talk through your own private arrangements. But for now, thanks very much for listening.